Benjamin Graham's The Intelligent Investor, 1949, updated with later editions, is considered one of the most influential books in investing history. It shaped generations of investors, especially Warren Buffett, who called it by far the best book on investing ever written. Here's how it shaped people. 1. Shifted focus from speculation to investment. Before Graham, many people treated the stock market like a casino. The book taught that investing is about owning businesses, not trading pieces of paper. It made readers think long term and avoid chasing fads. 2. Introduced the concept of Mr. Market. Graham personified the market as an emotional partner who offers to buy sell every day. Investors learn not to be controlled by market mood swings, but to take advantage of them. This idea gave people confidence during crashes and discipline during booms. Mar 3 popularized margin of safety. The principle of buying stocks at a significant discount to their intrinsic value became a cornerstone. It shaped cautious, rational decision making and helped people protect against big losses. 4. Created two types of investors. Defensive, passive. For those who don't want to spend time analyzing, Graham recommended index funds and conservative approaches. Enterprising, active. For those willing to do the work, Graham laid out disciplined methods of stock selection. This framework helped ordinary people see they could still invest wisely without being professionals. Namster 5. Influenced generations of great investors. Warren Buffett, Irving Kahn, Walter Schloss, Seth Klarman, and many others credit Graham's book for shaping their careers. Buffett said reading it at 19 changed his life. 6. Taught emotional discipline. The book emphasized psychology, patience, discipline, and resisting herd behavior. Many readers realize success in investing is more about temperament than IQ. In short, The Intelligent Investor shaped people by giving them a philosophy. Think long term, be disciplined, value businesses, and protect downside risk. It turned thousands from gamblers into investors. Do you want me to give you real life examples of how people applied its lessons, like Warren Buffett and others, or a step by step summary of its core rules? Let's go with real life examples plus core rules so you see exactly how the intelligent investor shaped people in practice. Real life examples. 1. Warren Buffett. Read the book at age 19 and called it the best investment book ever written. Learned margin of safety and Mr. Market concepts. Built Berkshire Hathaway around Graham's philosophy, buying businesses at fair or undervalued prices, then holding long term. Result, became one of the richest investors in history. Walter Schloss, Graham's student at Columbia, applied Graham's strict value investing rules, buying very cheap stocks, holding dozens of them. Worked alone, no computers, just discipline. Result, achieved 15% annual returns for nearly 50 years, turning small sums into huge wealth. Irving Kahn, research assistant to Graham when The Intelligent Investor was first published, lived to 109 years old, still investing late in life. Famous for patience and sticking to undervalued stocks. Result, built a legendary reputation as one of the longest living value investors. 4. Seth Klarman, founder of Baupost Group hedge fund, wrote Margin of Safety, 1991, which directly extends Graham's principles. Result, became a billionaire investor with one of the best track records in hedge fund history. Shash core rules shaping people. 1. Margin of safety. Don't pay full price, buy with a cushion. This shaped investors to avoid big permanent losses. 2. Mr. Market. Market is your servant, not your master. Investors learn to stay calm when markets panic. 3. Defensive versus enterprising investor. Defensive, use index funds, avoid speculation. Enterprising, do deep research, seek bargains. Shape people by giving both beginners and pros a roadmap. 4. Focus on intrinsic value. A company is worth its future earnings, not today's hype. This shaped people to think like business owners, not traders. 5. Control emotion. The book teaches discipline over IQ, shaped countless investors into steady long-term thinkers. So people who absorbed Graham's lessons either became successful professionals, Buffett, Schloss, Klarman, or smart, ordinary investors who avoided losing their savings in bubbles and crashes. Would you like me to make a simple step by step guide for you on how to apply the intelligent investor in your own journey to your first million? Great. Let's turn the intelligent investor into a step by step guide you can use personally to reach your first million. The intelligent investor roadmap to your first million. Step 1, decide your investor type. Defensive investor, passive. Don't want to spend much time analyzing. Strategy, use index funds, ETFs, broad market. Goal, safe, steady compounding. Enterprising investor, active, willing to study companies, read reports, value businesses. Strategy, pick undervalued stocks with discipline. Goal, higher returns but requires effort. You can even be mixed, 80% passive, 20% active. Step 2, apply margin of safety. Never buy a stock just because it's going up. Buy only when it's undervalued versus intrinsic value, cheap relative to earnings, assets, or book value. Example, if a company is worth 100 EGP share and trades at 70, that's your safety margin. Step 3, treat the market as Mr. Market. Market will tempt you with daily prices. Your job, ignore moods, focus on value. When others panic, you find bargains. Step 4, build a simple portfolio. Defensive path simple. 50% index funds, stocks, 50% bonds, treasury bills, safer assets. Rebalance yearly. Enterprising path, active. Select 10 to 15 undervalued stocks. Hold long term, 3 to 5 years plus. Diversify across sectors. Step 5, practice emotional discipline. Don't chase hype. Crypto, meme stocks, hot tips. Stick to rules. Remember, temperament, IQ, and investing. Step 6, automate wealth building. Invest monthly from salary. You already saved 3,000, 5,000 EGP. Compounding discipline will do the heavy lifting. Step 7, think in decades, not days. Graham's students became wealthy because they gave compounding time. Rule, the market is a voting machine in the short term, but a weighing machine in the long term. If you follow this roadmap, you'll 1, protect your money, margin of safety. 2, grow it steadily, compounding. 3, avoid emotional mistakes, Mr. Market. 4, build wealth in 10 to 15 years, reaching your first million. Do you want me to design a 12